All right, so we've covered all the asset classes. Next week we'll practice king question with the question 2, which is the asset allocation questions. So, all right. We got to talk about markets today because it's a pretty wild day. So the S&P, is that a big day? 1.5%. 1.5 sigma events. That's a pretty big day. Sorry. So they're saying is for jobs data, about the jobs data came out October 1st. The next job data will be on Friday. You are going to watch it on Friday. So what job data are they talking about? Jobs opening? The market doesn't react to that number. Why are they reacting to that number? It was higher than people were expecting. So it sounds like the demand for jobs is still strong, which is a good thing, not for inflation. I've never seen the market react that much to this number. I think they're reacting more to this number, a 4.8 10-year treasury. I think that's like 17-year high. That's a pretty high 10-year treasury, but pretty normal. The S&P, if you look at the 10-year treasury, it spends about half of its time, go back many decades, half of its time above 4.5%, half of its time below 4.5%. So 4.5 somewhat close to the median. So we're above the median, which we haven't been above in, a very, very long time. So anything else going crazy in here? NASDAQ's down 2%. We talked about growth versus value. What do we say about growth stocks and interest rates? Growth stocks like interest rates or hate interest rates? They don't like it, right? Because so much value is way out into the future. Higher interest rates has a bigger impact on them. So that kind of makes sense that they're doing worse. Small cap, how are they doing? They're kind of holding in there. Oil's up, another inflationary thing. Gold is down today. Why is that? Is the dollar stronger today? The dollar actually looks weaker today, but not much. It's pretty flat. The yen is down. Nikkei is down 1.6%. FTSE's down. So it's a pretty big day. It's been a pretty bad day for markets just generally. Let's look 6 months. So we had that. That's a pretty big drop. 4,500 to 4,200. It's about 8%. So it's not a bear market. A bear market would be 20% from top to bottom. We've actually had a bull market because we came back so strong. You can have a bull market and not hit previous highs because if you fall 20%, you got to come up 25% to get back to where you were. So it's interesting. I hit another buy point on the interest rates, so we'll see how far out my duration goes. I still got some room to go. But it's been an interesting market. You got to know this stuff you go into an interview, right? You're all about the interview here the next few days, next couple of weeks. So it depends on what kind of job you're interviewing for. Corporate finance, they may not care so much on that. But on the investment side, definitely you want to know what markets are doing. All right, let's get into the execution side. So we talked about this earlier on the execution side. Are you going to do it yourself or hire a manager? You can be active or passive. We're going to talk about fees and those different scenarios and all different types of things you got to consider. As far as hiring a manager, so when they made me head of equities at USAA, I hate mutual funds. So it was, people knew how much, so I'm in charge of all USA's equity mutual funds and strategy funds. So it was pretty hilarious because when Stuart announced his retirement, he's the guy that took his place. I had a staff meeting and someone on my staff said, hey, why don't you take Stuart's place? And the whole room started double over laughing. They thought, that's ridiculous. You'd never take that job. And so I took that job. And because I don't like equities, but I don't like mutual funds. But one thing I discovered when we came in is USA always graded itself against all the other big firms. And USA was always like 3rd, 4th, or 5th. And then Fidelity, there was a bunch of us kind of competing each other. 3rd, 4th, 5th, 6th. We kind of moved around. But there's one firm always number 1. And that was Vanguard, always number one. No matter what month it was, they always had the best score. That's who Jack Bogle is. And I said, well, that's because they're an index fund manager and their fees are so low. So I said, Michael, take out the index funds and regrade Vanguard. And he did that, and guess who came out on top 10? Vanguard. So it didn't matter. And so then I started asking, what does Vanguard do that everybody else doesn't do? And I came up with 5 things. If you were picking a mutual fund, the number one thing is fees. So Vanguard's fees are lower even on their active funds. In fact, you should read the history of Vanguard, because when Jack Bogle came in, he says, we want to do things cheaper than everybody else. And he actually got sued. The industry says you can't do that. You have to charge more. And fortunately, he won that lawsuit. Can you imagine an industry where they sue someone because they want to give a better product to the customers? Like, yeah, you can't do that. That makes life harder for us. But he won that lawsuit. And so his fees are lower. And Jack Bogle talks a lot about that. Fees are the easy thing. 2 managers, one charges at 1%, one charges 50 basis points. You go with the cheaper manager, it's a piece of cake. That explains a lot. The second thing is turnover. Turnover is how often do they trade? Firms that trade more often underperform firms that trade less often. Why? Because why do firms trade? A lot of times it's for the ego of the investor. They trade to make themselves look better, and it's not because they have a good idea. They're just trading the trade. It's just needless activity. And so when you look at this, we can look at a few funds. Let's try the Vanguard. Large cap. Let's just see what comes up. Let's see what comes up. All right, this is, I want, I don't want an ETF, I want an actual mutual fund. Vanguard, well, let's do the total stock market index. So I'm gonna look on their profile. So this is the total stock market index fund, but they have it under large cap. Sounds like that's large and small, isn't it? But it is, but large cap is like 80, 85, 90% of the market. So you know you're large and small, you're still dominated. But they could have put it kind of in the middle. It's core because it's not growth or value. It has $1.7 trillion in assets. The largest funds I've ever done are like, $5-10 billion. So I've never done anything that large. Look at the fees though. Fees are 4 basis points. And it's really not even 4 basis points, because especially with small cap, they do securities lending. They're probably adding 7 or 8 basis points to securities lending. You're essentially getting it for free plus an extra 4 basis points. So essentially free. What is their category charge? 36 basis points. Now, I don't know what this number means, but look at their turnover. 3%. That's a really low turnover. So Vanguard wins on 2 things: low turnover, low fees. I wish I could find an index fund. Here we go. Admiral funds. This will work better. So here's a large cap S&P 500. Look at the profile. So they charge 3 basis points. This is a fund with almost $1 trillion in assets. Vanguard getting up there pretty large, almost $1 trillion. They charge 3 basis points. The typical fund charges 84. So if they tie the 4 fees, they win by 80 basis points after the fees, which is a huge, huge difference. That gives them a major, major advantage. They almost can't lose over time because they have such a huge, huge advantage. And then look at their turnover. Where is their turnover? 2%. What is that turnover? Well, this is an index fund. The only turnover they have is when something new comes in the S&P 500. They got to replace one and add another one. That's their only turnover, 2%. That's really, really low. I had a mutual fund once. I went to its turnover was like 300%. I was so embarrassed by that fund, but it was the nature of the fund. I had to do that. It was just a terrible fund. I hated that fund. So this is a large cap core right in the middle, but it's an index fund. If you were to graph it against the S&P 500, you wouldn't be able to tell the S&P from the fund. They'd just be right on top of each other. If you can look at another one of my favorites, Fidelity Contra Fund. This is a great fund. We used to invest it in our 401k plan. It's not too big, $100 billion, 110 billion. It charges 47, so it's not particularly expensive, but it's competing against a 1% fee. So it gets a little bit of an advantage. Its turnover is 25%, kind of low, but still much higher than the index fund. The other problem with turnover, not only the high turnover underperform, but it also creates more taxes for you. So you have to pay more in taxes because the more turnover, the more capital gains you get. So it's kind of a double negative. What kind of fund is this? They say it's a growth fund. Kind of contradicts the name. Contra fund, you'd almost think would be a value fund, that it's buying stuff that's out of favor, but for some reason the contra fund is a growth fund. The Fidelity Magellan. I don't know how to spell Magellan. So only $28 billion in assets, 52 basis points. Pretty high turnover, almost 100% turnover. So they're trading pretty actively in that. That's a famous fund because of I forgot his name, but famous fund. The guy who's really famous, whose name I can't remember. So those are the two things. You just look at turnover and look at fees, and just based on that, if that's all your selection was, you'd probably outperform most investors out there. And the easiest thing on fees is index funds, because index funds are the cheapest. So you just buy index funds. You got it, because index funds have what? Low fees and low turnover. You're 2 out of 2 just from that standpoint. The next thing is something you can't measure, which is gains versus losses. So the typical retail investor makes a huge mistake. They buy a stock, it goes up 10%, they sell it so they can brag about it. Then they buy another stock, it falls 10%. We're not going to sell that, because if they sell it, they got to admit they made a mistake. So then it falls 20%, so I'm not selling it. Then it falls 30, and they say, as soon as it gets back to where I bought it, I'm going to sell it. Then it falls 40, then it falls 50. Finally, they sell it, and it comes back 70%. That's a typical retail investor, but guess what? It's also the typical institutional professional investor. You do the same thing. So if you actually grade managers based on their gain versus loss distribution, if that's balanced, those funds outperform the ones that are not balanced. The ones that are not balanced, they have a lot more losses and gains because they sell their gains too fast and they hold on to their losses. Why? Because of ego. Again, if you're making decisions based on what best supports your ego, you're not going to make money. So this is what Jack Bogle's book says. It's called Don't Count on It. It's not a book. I hate to say this because he's not around anymore. Really good. You should watch his YouTube. He's really good. But as far as a book, this is not the greatest book. It's not even a book. He just took a bunch of his essays that he wrote and he stuck them in a book. And so once you get to chapter 4, you're seeing the same stuff over and over again. So it's a little bit repetitive, but very good book as far as the concepts that he covers. Then I added 2 more from UTSA. The 2 other things we noticed. One is reversion to the mean. Managers that have done well recently are more likely to underperform. Firms that have underperformed recently are more likely to outperform. That's just a cycle, reversion and mean. And actually, my boss asked me to do an analysis. He said, I don't need the top 10% managers, just give me the top 25. So I found them. I may have told you all this story. I can't remember. Have I told you all this? But so I went through all the managers and I tried to find those that were consistently in the top 25. And I found 11 managers out of thousands of managers. I found 11 that were consistently top 25. And my boss says, yeah, let's hire them. And I said, that's good. The only problem is, if I just did this based on random chance, I should have found 13. If it was just pure random chance, the chance of being top 25% 3 years in a row is 0.25 times 0.25 times 0.25. It was just pure random chance. That times all the managers would have given me 13 managers. I found 11. So what is a what's most likely those 11 are. Just pure random chance. They're not really good managers. So the other thing that I did is I did a correlation graph. I looked at managers' performance like from 2000 through 2002, 3 years. And then I graphed the performance 2003 through 2005. I just graded last three to these three. And I graphed all of those, their ranking. And I wish I had the chart because it was just nothing but a bunch of dots. There was no relationship. And the slope was actually negative. Slightly negative. It wasn't impressive, but it's slightly negative. So firms that ranked high 1 3-year period were more likely to rank lower. But you couldn't have seen that slope without running the math because it's just a bunch of dots. So, but there is a little bit of reversion to the mean. So if you're picking two managers, you're better off probably picking the one that's done worse recently than the one that's done better. Now, what do firms sell? So Fidelity comes to USA, what do they sell? They sell the firms that have recently done well. And we'll say, well, what about these other men? Oh, we're not pushing them right now. Why not? Because they've done very well. Well, those are the ones we don't talk about. Those are the ones we're interested in. What managers have done well the last few years? Whoever had Microsoft, Apple, not Netflix, Nvidia, anyone had those stocks, they've done well. Are they going to do well going forward? Who knows? Maybe, maybe not. Are they going to be smart enough to get out in time before those crash? Who knows? And the other thing I noticed was manager longevity. One thing I noticed with Vanguard was the manager had a bad 2 or 3 years, they didn't fire him. They kept them in place. They trusted and kept them in. Other managers, a manager had like 3 days. I mean, not quite that extreme. It was pretty ridiculous. They had a bad quarter, a bad year, like fire and get someone new in. And that's because Jack Bogle says we're not in the investment management world, we're in the marketing world. The goal for Fidelity is not to get good managers that perform well. Their goal is to get good managers they can sell. And performance sells, not great processes. So Vanguard is just like, you got a good manager, they've done a good job over 10 years. They had a bad 3 years, big deal. Let's keep them there. They're smart. We know what we believe in the process. Any manager is going to have a bad 3 years, and they kept them. I told my boss that. It's like, yeah, that makes a lot of sense. Now, when are you going to fire this manager? And that's exactly the conversation we had, because we had a manager who had a bad couple of months. Everybody's like, when are you going to fire them? We drug our feet. We didn't fire them because we thought they were pretty good. That manager was our best performing manager that year. So I'm glad we didn't fire them. But that's the mentality here. You fire managers after a short period of underperformance, not because you don't think they're any good, but because you got to be able to sell your product. You got to be able to get rid of that history. So Vanguard is very good on 4 of those 5, and I don't know about number 4 because reversion to the mean, it's hard to really measure where they are on that. But fees, Jack Bogle will say fees the most important thing. Paying more for a manager does not get you more performance. There's no relationship between fees and manager performance, except for before fees, there's no relationship. After fees, obviously higher fees underperform. Now you notice there's some other fees in here. There's front end and deferred sales loads. You should never buy a fund that charges a sales load up front. It's just, that would be, you're just throwing money. I mean, can you imagine you walk in with $100,000 and they take $5,000 of your money away? What chance do you have of outperforming? It's just not going to happen. You're already $5,000 behind and you just started. And then if you take your money out, they're going to charge you another $1,000. So it's just terrible. There are the funds that still do exist. I mean, they're talking to average for the category is pretty high. 12B1 fees. Boy, that's kickbacks. Salespeople love those things. USA will refuse to pay them. People won't push your funds unless you pay them, but it's like, well, I'm going to pay you an extra % to sell my funds. They can just come to us and get it and don't have to pay those fees. So that's a ripoff. So yeah, pretty easy. That's the easiest thing to start with is what fees do they charge. Some big institutional managers charge front-end loads for retail investors because they just don't want them. If someone's stupid enough to buy the fund, then they'll take your money, but they're mainly going to institutional. Like Washington Mutual, I don't know if they're still out there. Washington Mutual. They used to be the largest. That's Waste Management. They used to be the largest fund out there. They're only 160 billion now, but they used to be the largest mutual fund. They used to have a large front end float. Yeah, they don't, it doesn't list it here, but they used to have a large front end float for the retail customers. But USA would get into it without that fee because, you know, you come with a few $100 million, they'll let you waive the fee. So what are you buying, or what are your parents buying, or your uncles and aunts? So this Thanksgiving, go home and ruin the lunch and dinner. Maybe do it after dinner when they're all sitting there. Hey, what mutual funds do you own, uncle? Say, oh, wow, you look at the fee on that thing. Why are you paying such high fees? Yeah, you can just really mess things up. I did that. I went to Europe for my first time and meeting people I never met before. One of the guys heard I was a portfolio manager. So he goes, I got the best broker ever. And I go, how do you know? He says, oh, he sends me trades all the time. He says, well, that makes him money. How do you know he's making you money? I've messed up the whole trip for the poor guy, but it's fine. I mean, someone says they got the best, whatever, doctor or broker. You're like, well, how do you know? And he didn't know the answer to that. The fact that he's making money off of you is not a good indication he's doing a good job for you. All right. So when we're looking at doing it yourself or buying managers, there's a few laws that were passed. The 1933 Act, 1933 Act, is if you're going to buy your own securities, this is your protection here. What do firms have to provide you as far as information so that you can be a good investor? So if you're going to do your own security selection, you're under this act. You're going to hire a broker, and all of you should have a broker. You're going to buy stocks yourself. You can buy bonds for your broker. I don't highly recommend that, but you could do that. In fact, I would recommend you never buy bonds from a broker. You should buy mutual funds on bonds. If you're going to buy bonds like treasuries, you should just buy them directly from the treasury themselves. And just go to Treasury Direct, why pay fees and all that kind of stuff. The broker trades through in electronic trading these days. There are over-the-counter trades, mainly for large corporate bonds. You're not going to be involved in that. I say $5 million blocks at USA corporate bonds. They're trading them in $500 million blocks. It's like you need a lot of volume to be able to compete there. That's why you, as a small investor, do not want to buy bonds. You're going to get absolutely killed on the transaction fees. It's going to cut your return several percent. So corporate bonds, muni bonds are very, very liquid. If you're not a big investor, you probably should just buy the mutual funds. What trades can you do? A market order, you just say, I should have set up my broker so I could do a trade. I did a trade earlier, but I should have waited and done it here. But I did a market order because I was in a hurry, just go. A market order just says, hey, give me the best execution you can get. Buy now, whatever the market price is. If you can find the volume, do that. A limit order is when you want to buy a stock, but you think it's maybe a little too expensive. Maybe it's trading for 104, you want to buy it at 100. So you can say, hey, if it hits 100, buy it. If it doesn't hit 100, just don't buy it. And so that could be an order that's good till canceled. Usually good till canceled might last 30 days or whatever. So you got to make sure you're aware of that. If you're selling a stock, like you've got a stock that is currently trading for 95, you want to sell it for 100, you could put a limit order and say, hey, if it hits 100, sell it. A stop loss is you bought a stock and you say, hey, I bought it for 670, but hey, if it hits 640, I must have messed up. So you put an order and say, hey, if it hits 640, just sell. I'm going to cut my losses at 30 bucks. Now, will they sell it at 640? Well, if it closes at 670 today and opens at 600 tomorrow, guess what they're going to sell it at? They're not going to sell it at 640, are they? Be nice if they could. So if you have a discontinuous market, the stop loss is not going to protect you at 640. So if you're going to do it yourself, you're competing against people who do this 60 hours a week. And on the sell side, they're covering maybe 10 stocks. So you talk about a 2,000 hours year covering 10 stocks. They're spending 200 hours per stock. that they cover. Do you have 200 hours per company? So you're not going to cover 10 stocks, right? Because you have to have 40, 50 stocks in your portfolio. You got to cover 500, 600 stocks. Multiply that by 200. That's the kind of time it takes. It is not easy if you don't have the time. So it's pretty tough. So this is the question I asked: how do you know your broker is doing a good job for you? So the real key is, are you beating benchmarks? If market's up 13 and you're making 12, you might as well just buy the market. Save all that time and effort. Why go through all that trouble? It's tough. There's not many people who beat the market consistently. And the ones that are, they don't tell you what they're doing. Now, if you hire a manager, now you're under the 1940 Act. So mutual funds are regulated by the 1940 Act. So what kind of securities do we have? There's mutual funds, there's commingled accounts, there's separate accounts. So mutual funds, investment companies, they create this trust. They commingle all the assets of several investors, and then there's some management. So people get confused with USAA and Victory Capital. So USAA has mutual funds. They're USAA's mutual funds. They sell them. USAA used to have an investment company that manages the mutual funds, but they don't have to use their own management firm. So USAA fired their investment firm and they hired Victory Capital. Okay, fortunately, they fired them after I retired. Not that I had anything to do with that, but they fired their firm and hired Victory Capital. And so they essentially outsourced all that to Victory Capital, but there's still USAA funds. So you can still buy USAA funds. So the investment companies, their money, managing monies for their own account or for other people's accounts. The big ones out there, obviously BlackRock and Vanguard are the two largest. Fidelity, T. Rowe Price, there's several of them out there. You buy in a mutual fund, one limit is you can only buy once a day, and that's at 3 o'clock. Whatever that closing NAV is, net asset value is, that's the price you are going to get. Now, when do they have that NAV? Usually around 6 o'clock, they'll start showing up. So all the accountants, I had to do this once, it's kind of fun. I worked in USA's on the life side. They had some variable products that had NAVs. And the lady who did that was pregnant. So she went on maternity leave. I volunteered. You always do that, right? And they say, hey, I'm going to be out a few weeks. They may want it. Your hand's already out. And they say, does anybody, you already have your hand up? Yeah, I'll do it. So I did that job for a while. It's pretty cool doing NAVs because I have to find an NAV times the number of shares that exactly hits my net asset. Sometimes I was going out like 12, 13 decimal places, because I had to get exactly number of shares times the NAV. And I just went as many decimal places as I could. And that is the price you'll get. So you don't know what price you can get until close of business. So whatever that is, you'll get it. Are there ever errors in NAVs, do you think? Is it possible for an accountant to make a mistake? Do you have accounting friends who have never made a mistake? Probably not. So it does happen. It happened at USAA. I remember once I was looking at my NAV at close of business, and I called the accountant and said, there's no way that number is right. They all started panicking. Unfortunately, I hadn't come home yet, and they found they had transposed a number or something. They were glad I called them, even though I had to be there till 10 o'clock. They're glad I called them, because if they had not caught that, all those trades would have happened at the wrong NAV, and the next day they would have had an absolute mess. They would have sent people too much money. They would have gotten other people too few shares. Can you imagine them going after people and say, hey, we sent you $1,500, but we should have only sent you $1,400. It would have been a mess. So they were glad, even though they had to work some overtime, they were glad I caught it. So I was looking at my NAVs at the end of the day just to make sure that made sense. That was the only one time that is wrong. Now, there was one time some guy, I don't know where he worked, but he made an error on the S&P value, which is using all these funds, and oh, that caused that poor guy, he probably lost his job. That was just a disastrous mistake. Generally, 99.9% of the time, they're going to be right, but they're very, very important that they get them exactly right, because people are getting money, people are getting shares. So you can always get the NAV at 3 o'clock San Antonio time, 4 o'clock. You can always get that. You got to get your trade in though right on time. So if you do it at 4:01 or 3:01 San Antonio time, you won't get it. Once the market closes, you're out. You can get fractional shares. That's kind of nice. You can buy 523.27635. You really just say, I want $5,000 worth, and they'll divide that up for you. The advantage is small investors immediately become well diversified. So you may only have $2,000 to invest, but you put into this fund that's 1.3 trillion, and you're going to have a very, very well diversified portfolio with your $2,000. Most mutual funds have a minimum of say $3,000, but most of them also, if you do a Roth IRA or traditional IRA, they'll let you come in for $50 a month as long as you sign up for direct. You do 50 every month. They'll let you come in at 50. So that's kind of nice for a really small investor. You can get in to some really massive funds. It allows you as a small investor to hire really good trained portfolios without having to have a lot of money. I mean, we saw with Vanguard, $1.3 trillion portfolio, and they're going to charge you 3 basis points. You got a really good investment for almost no cost. So a commingled account is essentially, and a separate account, somewhat similar, but a commingled account is essentially a mutual fund for really big investors. So Vanguard might have a mutual fund, but they may also have a commingled account, which only has like 10 investors in it. And each one of them may have $400, $500 million. You get lower fees, you get a little more better treatment. A separate account is similar to commingled, but a separate account is when you go to Vanguard with $500 million, you tell them invest this money just for us, and they set it aside just for you. It's just your money. All of those get NAVs at the end of the day. You know what you have. They don't have tickers, so you can't do these. You can't do commingled and separate accounts. But large investors will tend to do those type of investments. But now the most popular thing is exchange traded funds, ETFs. Have y'all been buying these things? So my guess is most of you are going to buy ETFs and not mutual funds. If you look at the lines, mutual funds have been coming down, ETFs have been going up. I do love ETFs. They have some tremendous advantages. I buy them all the time. The only mutual funds I have are bond mutual funds. I could do bonds and ETFs, but I tend to do my bonds and mutual funds. So an ETF is essentially a mutual fund that's traded like a stock. So you can essentially go out, you get a ticker, you can buy it. So Vanguard has mutual funds, but they have ETFs on those same mutual funds. BlackRock has mutual funds, but they also have spiders. No, they have iShares. And then State Street has mutual funds, but they also have the spiders. So these are essentially mutual funds, but you can buy them intraday. They do give you some huge advantages on tax-wise and other ways that you can invest. Now, if you're a massive investor, they may not want you to go out and buy the ETF on the market. So they have what they call exchange. Forget. Man, I've been away from this for so long. But essentially, you can go to them and say, "Hey, I want to put $500 million into your ETF." And what they'll do is they take your $500 million and they'll put it into the fund without disrupting everybody else. So you get kind of these direct exchange, and you get your shares kind of off to the side. So you can control things a lot better with these, and it probably is nice to be able to trade intraday. That can be kind of nice, and you'll get your money really fast. Mutual funds, if the mutual fund's really struggling, their perspectives can allow them to hang on to your cash longer than you may want them to. You may not get your money immediately, so it usually takes a few extra days to get your money from a mutual fund than it will from an ETF. So you have a lot more control. It's just a lot better. I'll show you some ETFs later as we get into what they've gotten kind of crazy. And then there's your 401k plan, which most of y'all will do that, I imagine, right? So that is essentially a commingled account. Some of them buy mutual funds. I doubt many of them buy ETFs, but they buy mutual funds. They do a lot of commingled accounts and separate accounts. We did all of those. We had separate accounts on the fixed income side. So all of those are available, but your 401k is your money, probably matched by your employer to some extent. And it just sits in there tax deferred. You got to pay tax on it when you take it out, unless you do a Roth 401k plan. Have y'all seen those Roth 401ks? So you can do it where you don't get it with, you have to buy it with after tax money. So you pay tax on it today, but it's tax free forever. I think I would be looking into that as well. How many of y'all have a 401k? You have y'all from your employers? Are they matching pretty well? No. I forget what I think USA was matching 8%. They canceled the pension plan, which made me really mad because I was in charge of the pension plan and I begged for them to keep it. But they canceled it and they just increased the 401k to 8%. So that's pretty good. That's the kind of free money. All right. You got to be careful on the matching though, because there is a vesting. So you have to work there 5 years with to be your money. Now your money is your money, that you never lose, but the employer match, you don't get that just overnight. What do you have to watch out on a 401k plan? You have to watch out for bundling. So there's a few things at USAA I was willing to fall on my sword, and this was one of them. We had 2 HR people, actually 3, that wanted to bundle USA's 401k plan, and I fought so hard against it. I think it's a ripoff. So one thing you have to realize, I was managing the 401k plan, which made me a fiduciary. What does a fiduciary have to do? All of my decisions have to be in the best interest of whom? Yes. The 401k investors. I can't make any decision that benefits USAA. What does bundling do? Benefits the employer. So it's illegal on the surface. So what is bundling? So what USAA wanted to do was bundle, so USAA was hiring a firm like Vanguard or JP Morgan or whoever and paying them record keeper fees. The record keeping fees, a few $100,000. And Fidelity says, hey, you know what? If you bundle with us, you bring all your money to Fidelity, we'll put your employees in our funds and we'll give you record keeping for free. Now, why would Fidelity do that? They're gonna make a fortune off your employees. And I've seen sometimes where the 401k plan has a manager that's charging 40 basis points and they bundle it and that same manager now is charging 80. What just happened to the employee? They're just paying twice as much in fees. The employer loves it. They just say $500,000. Is there any way to argue that's in the best interest of the employee? Absolutely not. Small employers almost have no choice. They have to do that. That's the only way they can afford it. But large employers like USAA know. We hired one guy in HR for human resources from Dial, and he comes in and he's kind of an arrogant guy. He goes, I can't believe you guys are so stupid and you're not bundling. And we'll look at it again. And at the end, he was kind of embarrassed at how much damage he'd done to his Dow employees by bundling there and said, yeah, it's not in their best interest. And I use that as my ammunition. Anytime these came up, it says, is that in the best interest of the plan participant? Because that's the only decision we can make. And on that one, it's not. So if your firm is bundling, you might ask them why they're doing that. ERISA, which manages these things, had thought about making that illegal some time ago, but they couldn't win, obviously, because the industry doesn't want them to win. It was kind of interesting to me because when we went to Vanguard, we went out to all these firms that do bundling, and we added a question that said, explain why bundling is in the best interest of the plan participants. And Vanguard dropped out. They couldn't come up with an answer for that. There's a really good, if you look on my recommended book list, there's a really good frontline documentary on this, and it's hilarious hearing how the industry justifies this stuff. It's pretty funny. I don't know how these people sleep at night. I guess they get paid so well, they kind of figure out a way to get around it, but it's pretty sad. So we got a pretty evil industry, and that's one of the evil things we do. All right. Index funds, how do you pick index funds? Low fees, and you look at the R squared. You just correlate them against the index. So like Vanguard, you take the Vanguard 500 index fund and you correlate it against the S&P 500. The R squared is going to be 99.99%. You almost can't tell the difference. So that's pretty easy. Low fees, low tracking error, high R squares. That's what you need. So index funds are the easiest, and index funds, there isn't economies of scale. So an $8 trillion company is going to do a whole lot more for you than a $1 trillion company. So go with the big guys, get the lowest fees. The biggest firms are going to have the lowest fees anyway. And you need to know all your major indices. So the S&P 500, that's a stock index of 500 companies. It is 500 companies. It's not the 500 largest. It's the 500 of the largest. Because I don't think Berkshire Hathaway is in the S&P 500, or it hasn't been. Berkshire Hathaway is a big firm. So there's sometimes they don't put everybody, and one reason they don't have everybody in there is they want to represent all the different industries. So the S&P, there's some debate, is the S&P really passive? Because the S&P 500 committee is making a decision about who's in and who out. They should be making a decision based on who they think is going to do well, but they do want to have good representation. So there is a little bit of kind of active going on there. And then if you buy the S&P 500, how should you weight it? Well, the S&P 500 is market cap weighted. So Apple's the largest stock in the US. It's also the largest weight in the S&P 500. Now, do you have to buy market weighted? You could do equal weight. We'll talk a little bit about that. The Dow Jones, who knows? It's a price weighted index. We don't even know what that means. I mean, when you start it, it's pretty obvious. If a stock's trading for $500 and another stock's trading for 100, they're going to put 5 times as much. Now that makes no sense because does that stock have to be 500? What could they do? They change their stock price. Yeah, if they do a 2-to-1 stock list split, now what is the stock? Now 250. So what does Dow do when they split? They don't do anything. They just keep track that it's split. So now when you look at it, it's a mess. You don't know which stock. So you can't weight it anymore. So I don't even know how to do it. They may just have some computer program that's just massive. So just because a stock splits from 500 to 250, they don't cut its weight in half. They keep it there. And so it's just a mess. That's why you don't talk about the Dow Jones in interviews, because it's just not a very commonsensical one. Frank Russell, he got famous for small cap stocks. So the Russell 2000 is the most popular small cap index. It doesn't have 2,000 stocks in it. So the S&P does have 500. The Russell is only reconstituted once a year. So if a company goes out of business or 2 companies merge, you won't have 2,100 stocks, but you could have 1,992 or something. And then once a year, it's exactly 2,000 stocks. We say it's small cap. It's really mid cap and small cap. So Russell has a Russell 1000, which is their large companies, and the 2000, which is their mid and small companies. S&P has the 500, which is large cap, the 400, which is mid cap, and the 600, which is small cap. So they have their other industries, but Russell's just been the most popular one. The only mid cap we really talk about is the S&P, but you know, Russell could create a mid cap indice. Developed, it's MSCI EFA. MS used to mean Morgan Stanley, but Morgan Stanley sold off MSCI. So I don't know what MS stands for now. It's just MSCI. Kind of like USAA used to be United Services Automobile Association. They eliminated that. And now they are officially USAA. So MSCI used to be Morgan Stanley Capital Indices, but now it's just MSCI. EFA is, oh man, Europe. Maybe that's Australia and in Far East. I'm not real sure. I never remember. It doesn't include Canada, so that's a little bit of a problem. So if you want all the developed markets in the world, you can't do EFA because then you don't have Canada. So you'll also see indices that are EFA plus Canada. So they're just added in. Why don't they just add in Canada? But that's EFA, MSCI. How do these firms make money? It's through trademark. So if you want to do an S&P 500 index fund, guess who's going to be calling you the next couple of days? S&P, they want a cut. You have to pay them a fee. I don't know how much it is, but you got to pay them a fee. So yeah, they make money. Same thing on MSCI, Russell. So go out and create an index. If you can get it accepted, you can make money just, you know, sitting at home watching TV. You know, they'll be paying you every time they use your indices. Vanguard got smart on some of these indices and said, you know what, we'll just create our own indice so we don't have to put it in our name. And people trust us and they'll let us do that. They could get away with that, but they still have to have a Vanguard S&P 500 fund because it's just so well known. They can get away with making their own emerging market indice, but some things they have to pay the fee. Emerging market, MSCI, anything international, we tend to think of MSCI. That's just their thing. Now, MSCI does have a U.S. large cap, U.S. large cap growth. They have all those as well, but we just don't think of them in the same way. Yeah, so all of these will have growth, value, all those different types. On the bond side, it used to be the Lehman Ag, and then it was the Merrill Lynch Ag. So don't name your firm don't get your firm named for a bond fund because you'll go out of business. Then it was the Barclays, and I don't really know what they call it now. It's just keep changing. So Barclays bought all the Lehman stuff because they wanted U.S. fixed income. So the Merrill Lynch, I think, is still around, but it's owned by Bank of America. So who knows what the aggregate is. There's a big problem with bond aggregates, though. I haven't looked in a while, but last time I checked, these things are like 70% treasuries and mortgage-backed securities. And I think it was like 40% treasuries and 30% mortgage-backed. I would never put 30% in mortgage-backed securities. So this ag is just whatever the market is. So most people don't buy the ag, they may buy a corporate bond fund. So Vanguard has an index corporate bond fund. So it takes the Barclays ag and just pulls out the corporates. But even that's a little bit of an issue. So do you index bonds? If you index bonds, your largest allocation is going to be whatever firm borrowed the most money. And that may make you a little nervous. They want to allocate my bonds based on who has the most debt. That seems a little tricky. So, but the funny thing is, Vanguard's bond index funds have done extremely well. So, you know, why? Because their fees are so low. On bonds, it makes a much bigger difference. Lower fees makes a much bigger difference on bonds. So how should you weight them? The original, when they first started talking about this in the 60s, was equal weight. So if you're going to buy the S&P 500, put 1 500th in each stock. Well, that's a pain because every day you're out of weight. You're off. So you're going to re-weight every single day. One stock goes up 1%, one goes down 1%. Now you're off. So how often do you rebalance? So it was just a pain. If you use market weight, then if stock goes up 5%, it's still correct because you're market weighted. So market weight, you don't have to trade so much. So it's extremely expensive, especially for large investors, to maintain that equal weight. You're probably not going to rebalance every single day anyway. You might rebalance once a month or once a quarter, but that's still, if you got 500 stocks, how many trades do you have to make? 500 trades. So it's just really, really expensive. However, people have discovered that equal weight outperforms market weight. Now, why is that? I should say on all of these, until recently, equal weight has outperformed. Anybody want to guess? See how astute you are. What is the key? We talked about it on the bucks. What is the key on the bucks?
Oh, you have more small cap.
Small cap can be part of it. And what else could be part of it? So if you equal weight, what are you doing with small cap versus large cap?
Well, you just, rather than overweighting large cap.
Yeah, you're overweighting small cap, so you have more small cap. What else do you have? Equal weight. That's good. That's astute. You don't have many letters left. It's not international. Yeah, if you equal weight, you're overweighting small cap and you're overweighting value. And historically, small cap and value have outperformed large cap and growth until recently. What's outperformed recently? Large cap growth. So that hasn't worked. So is equal weight a good strategy, or should you just market weight but overweight small cap and value? You might end up with the same thing. So there is some sense that it's really, there's nothing magical about it. It's just buying what tends to do well. Then we've had this thing called fundamental weight. Robert Arnott, you should put him into your reading list. I don't think he writes books, but he writes a lot of articles. He's out there on YouTube. Amazing guy. I've only met him twice. I saw him at a conference, and as soon as he finished talking, everybody's running out and calling a broker. So he's quite a persuasive speaker. I thought he was kind of not arrogant, but he was like not talking to people. And I discovered when I met him later, he's just a real shy guy, but he's a really, really nice, down to earth guy, really nice guy, really brilliant man. So you should follow what he writes and what he posts out there. He is a big pusher of fundamental weighting. And what fundamental weighting means is instead of using market cap to weight, you use some accounting measure. Maybe it's revenues, maybe it's net income. Some measure you can say, hey, we're going to weight it on some other value besides market cap. If you really want to get in here, a good way to do this would be to look at the debate between two of the champions. So Robert Arnott business. So these two guys, Cliff Asness, I highly recommend you read everything he writes. He's won many awards. He writes some great articles. He's out on some podcasts as well. These are old pictures. They're much older than that, but they're having this debate, and you have these two brilliant investors. You want to hear everything they have to say. They like each other, but they criticize each other pretty harshly. They strongly disagree with each other. Cliff Asness, he's a hedge fund manager, very factor based, so very quantitative manager. And so the two of them debate. They highly respect each other, but they disagree, and so you can probably find them on a YouTube debating each other. Yeah, Cliff Asness runs AQR. There it is, Arnott, sin a little by timing factors. Yeah, there. One thing I love about Cliff Asness is the title of his articles are wonderful. He likes to use real provocative titles to kind of say, wait, what is he talking about? Some of them are kind of, you won't repeat them in mixed company, but he's trying to get you to read his articles, and he does that. So notice here it says non-cap weighted indices. What do they mean? Cap means the largest get the highest weight. So non-cap would be equal weighted or fundamental weighted. So it's a big debate. So you can see him in YouTube's. He's all over the place. He talks quite a bit. He's on podcasts. He's out there. I haven't looked at their website in a while. I bet he has some great articles on his website. If I'm assuming it's AQR. See if he has education. Look at that. Research. Cliff's Perspectives. I should start reading this. Yeah, you see his titles. So yeah, I'd be reading him. I need to now want to just change the class and go read Cliff Asness, but really, really smart guy. So there's the base on this. Exactly how do you put a portfolio together? If you're not sure, just the traditional index fund is probably fine. There's a lot of debate. No one's saying anything's right or wrong. So fundamental weights have the exact same issue that equal weight do. You tend to be overweight small cap and overweight value. You do that. And that's what Cliff Asness actually says. Equal weight is nothing but value investing. You're buying stocks that are cheap, and cheap stocks tend to outperform expensive stocks. So it tends to be a value play, except for recently it hasn't worked well. I gave you the methodology for S&P. You can look up MSCI. They have their methodologies out there on their websites. S&P's is nice and short and to the point. MSCI's goes on for hundreds of pages, but there's a lot of good stuff in there. Really interesting stuff. It's very quantitative, how to put together an index and do it correctly and make money off of it. But interesting stuff. All right, there's other indices out there, obviously international indices, so you can go look those up, specific countries. All right, so let's quickly talk about active versus passive investing. So active, you're trying to beat the market, which means it's going to cost you money because you got to do research, you got to hire people to do the analysis. And there's firms that are very, very quantitative, but even they have to have one or two people building the model. I remember when I retired from USAA, I went and visited all our managers in New York. So I went and visited one of our international managers, very quantitative. So I wanted to see their model. I was expecting to go in this room with all these computers and other technicians and white coats and all this kind of stuff. No, it's Bob's desk. It's on Bob's desk. It's this computer Excel file. And it's like, oh, that's what we're sending you hundreds of millions of dollars for. But yeah, it was just one guy had a model on his desk. But it still costs him money. So you have to hire Bob. So there's a cost to it. The S&P index, if is up, say 4.2, you got to be up more than 4.2 to beat it because of your expenses. The key is process. You got to have a process that is repeatable and has some statistics behind it that it actually wins. We'll talk about that later when we talk about your kind of your philosophy, your investment philosophy. And investment philosophy starts with the words "I believe." I believe stocks with these characteristics outperform stocks without them. Those characteristics you could say was split pastness. One thing he's talked about that I want to try, I haven't got around to it. He says small cap value is the place to be, but recently hasn't done so well. However, if you rank small cap stocks by quality, you use the Bloomberg quality, and you get rid of all the really horrible small cap value stocks, you can beat markets with that strategy. That's the strategy. Will it win every single year? No, some years it's not. But if over the long term you're going to win, then the question is how much will you win by, and then how much does it cost you to do that? So you got to find managers with good processes that can consistently outperform. Now you notice with our managers, our managers, they have Morningstar ratings. That's a 3-star fund. 3-star fund. 4-star fund. What do you want Morningstar fund stars tell you? Absolutely nothing. So I had Michael do that analysis. Michael, once a company gets rated 4 or 5 stars, how do they perform versus 2 stars? And what he discovered was there was no difference between 2, 3, and 4-star funds. 0. 1-star funds, you want to avoid them. They're a disaster. But 2, 3, 4, 5-star funds, no difference in performance. So what is Morningstar telling you? That fund has done well historically. Tells you nothing about how they're going to perform going forward. That bothers me because there's a bunch of CPAs out there making a fortune, expanding out to wealth management, buying funds based on their Morningstar stars and their 12B1 fees. And there's no evidence they're adding any value at all. They're just charging a lot of money. So yeah, buyer beware. So performance is extremely inconsistent. I'll have to show you all the numbers. They're pretty sad. I'll show you next class and show you numbers. They're pretty sad. It's not that they underperform 52% of the time, or 50, it's like 85, 90% of the time. Active managers underperform passive. Why? Because of the fees. It's just tough to do. So passive, you just buy an index fund, pretty straightforward to do. You're probably thinking markets are efficient. So we'll talk a little bit about market efficiency. Have y'all had market efficiency yet? Efficient market hypothesis, does that sound familiar? I don't think we talked about it in my 3013 class at all. So efficient market hypothesis just says markets are extremely efficient, so much so they're really hard to beat. But there's 2 ways to define efficiency. Sorry. I don't know how to turn it off. I forgot to hit it, put it on airplane mode. But all right. So markets can be informationally efficient or they can be fundamentally efficient. Information just means that once information goes out, everybody gets it and they react to it immediately. It doesn't take 4 weeks for us to get information. And today that's really true, right? On the internet, you know within a second that something's happened. Fundamental efficiency means when people get the information, they interpret it correctly, or to the extent they don't interpret it correctly, the errors offset each other. There's no bias one way or the other. All right. How true are these 2 things? We know they're both untrue, but how untrue are they? Are they untrue enough that you can make money by being an active manager? Are they true enough that you might as well just index because it's close enough to being true? So that's the question. We'll talk a little bit more about that next time. All right, so on Thursday, we're going to finish a little early so you can go to USA. Hopefully, y'all all go to USA. I need to have a good crowd so they'll come back, as they are hiring our students a lot. We love our students. So make a good showing if you can. Any questions on anything? So let's talk about active versus passive in this whole efficient market hypothesis. So as we said last time, active, you're trying to beat the market. It's going to cost you money to do that. And it's just as hard to beat the market as an investor as it is to find managers who will beat the market. Those are both really hard. I don't know why I don't think it's true today, but there was There are more mutual funds in the United States than there were stocks. So there's a lot of people who are trying to beat the market. How do you do that? At USA, I gave you my list. It's fees, it's turnover. The only thing we could find that that really was forecastable was the batting average. I'll show you batting average. That one's kind of seems crazy. That would actually help, but that one has a little bit of predictability. But there's not many things that actually predict. History definitely doesn't predict. Just because someone's done well in the past really doesn't tell you anything about the future. So on active, I think the key is process. So we'll talk about this later. When you're doing a portfolio, there's four things. There's philosophy, process, construction, and risk management. So a good manager is going to have a good philosophy. They're going to say, we believe these type of stocks beat the market. That's going to be their overarching philosophy. So GMO, it's momentum and quality. Those are the two things they're looking for. All right, so that's philosophy. The process is, how do you find those stocks? Is it a computer? Are you doing research, management visits? When I was at USA as an analyst, firms came into USA all the time and go do these, they do their presentation. You go in and ask questions. So the sell side would come in, and it was always fun because they take us to lunch and we go hear them talk about it. There's some firms, some portfolio managers, they do not do any company visits. They say that's going to make us biased. We don't want to hear the CFO talking. We want to make our own analysis. So there's different philosophies on that. So how do you find these companies? Most people, the computer is going to do a lot of the work because you've got several thousand companies out there. So if you want to learn that, we do that in the Investment Society. I have my YouTube channel that shows you how to actually build a stock screening model. You can do that, but will you beat the market? So that is your process. And then construction is your process has identified 80 stocks you want to buy. Well, how are you going to buy them? You're going to put 1/80th in each one. You're going to have some kind of optimization routine. How do you actually build that out? And then the last step is your risk management, your sales discipline. When are you going to sell this stock? When it hits your target price. So that's the kind of thing you're looking for. Managers that have a philosophy, a process, construction, risk management, and they can well define it. At USA, what we did when we interviewed hundreds and hundreds of managers is we wouldn't look at their performance before we interview them. And we hear what they'd say, the process, philosophy, all of that. And then we'll go, oh, you know what, with that philosophy and process, you probably had a really horrible 2015. And then we look and they beat 2015. It's like, well, wait, how did you beat 2015? Then you discover they just gave us a marketing pitch. Like, well, that's not the way you really do it. Okay, well, what do you really do? Or we actually aren't interested in you now. So we try not to let their history, their performance mess up on what their process is. We want to hear them well explain that process. You need to have that if you're going to interview in some of these firms. What is your philosophy? What is your process? We'll talk about it later, but there's some pretty popular ones out there. GARP's probably the most popular one, growth at a reasonable price. A lot of people are just naturally GARP. They want really good companies that are cheap. They don't really exist, but maybe you'll find one. I mean, do you think there's a stock out there that's like greatest company in the world and it's really cheap and you're going to be the first one to find it? Do you really think that's going to happen with the millions of people with their computers and MIT degrees? So it's going to be tough. Performance itself is not all that helpful for you because there's a lot of luck that messes up the numbers, pure luck. So, and it's hard to distinguish between luck and skill. The statistics say if you're going to try to grade a manager and how good they are, you need about 70 years of data. Well, by 70 years, they're 90 years old. They're probably retiring. And even if they're not retiring, there's a good chance what happened worked well for the last 70 years stops working going forward. And even then, it's not any good. So statistics assumes that history of 7 years is going to be consistent with the future. But with AI and everything else, who knows what the future is going to be. So it's tough. Active investing is really, really tough. Passive is really, really easy. You just buy the market. Low fees, high R squared. So just to show you some numbers here. So I've got two lines on this chart. Can you see the two lines on this chart? This chart has two lines. Can y'all see it? Where's the two lines on this chart? Yeah, it's the Vanguard S&P 500 fund and the S&P 500. Who did better? Kind of hard to tell, isn't it? So they charge a fee, but do you see the fee in there? You don't even see the fee. They essentially give you the market. How predictable is that? If the S&P is up 1% today, how do you think that fund did? Would you be shocked if they were down 2% today? You'd say, okay, there's something wrong. So it's probably going to be up 1% exactly. The R squared on that is like 99.99. I mean, it's pretty close. So you don't have to do a lot of research. You just watch what the market does, and that's what they're doing. You're done. It saves you a lot of problems. What kind of asset class is this? Based on exam 1 question. It's core. What else? Huh? Well, it's passive, but that's not an asset class. So an asset class. So it's core. So it's not value growth. It's combined. Although the S&P is actually a little bit growthy, but it's kind of, we call it core. What else is it? Think through bucks. Give me all of them. So we got the S on bucks. That's only one.
Oh, it's large.
It's large cap. All right. There's the C at the C and S. It's US. What else is it? What's the beta of the S&P 500? Anybody know the beta of the S&P? It's 1. So it's not defensive or cyclical. It's just 1. All right. So the S&P 500 is a large cap core US, and it's not landed toward cyclical or defensive. Now here's Contrafund, and it looks like they've grossly underperformed, but that's because Yahoo Finance makes one huge mistake, and that is on capital gains. When firms distribute capital gains, their mutual fund price drops a bunch, but you're fine. You know, the fund drops $5,000, but they send you $5,000 in cash. You're the same, but this doesn't capture that. It looks like the fund, and there's some years the distribution is like 10%. So you can see why that would really mess up the returns. I wish Yahoo Finance would fix it. They do fix dividends. They do have an adjustment for dividends, but they don't fix for capital gains. And so I created this spreadsheet from our risk management class. Here's the Contrafund, and here's the S&P indices. It's actually done quite well. So I got this out of Bloomberg. Bloomberg has a total return function that includes dividends and capital gains, stock splits, and all of that. So that's how you want to build it so you can do the comparison. And so in the Contrafund, their return was 13.36%. They're listed as a growth fund, so I brought a growth index in there. So that's their return. Their risk is actually a little lower than growth funds. Their risk standard deviation is 14.4. That looks pretty good. Their alpha, what is alpha? That's just their return minus the market return. So their alpha was 279 versus the S&P and 319 versus the growth. Remember Morningstar said they're a growth fund. The tracking error, anybody know what tracking error is? Right, so their alpha every month is a number, right? So we can look at their alpha. So here's their return. There's the S&P 500 return. So their alpha is just the difference. So in that first month, it was 2.34%. The next month, they slightly underperformed, really outperformed, really outperformed, really underperformed. The tracking error is nothing more than the standard deviation of all those alphas. So what would the CPR following here? The Vanguard 500 fund, what do you think its tracking error would be? 0, yeah, essentially 0. For the Contrafund, because it's an actively trading fund, their tracking error is 1.88%. That's pretty standard for an active fund. I've seen some much higher than that, but that's pretty typical. So they're not way off. And essentially that tells you how far away could they be from the S&P 500. So you think about that as a standard deviation. The S&P 500 is up 2%, then 2/3 of the time they'd be between 0 and 4%, like about 188 to that. So tracking error is a really good statistic. If you're talking to wealth management interviews or talking to firms, you want to know what an alpha is. Alpha is pretty easy. That's just how much you beat the market by. and then tracking error. The only thing I don't like about it is alpha is on an annual basis, but tracking error is a monthly number for some reason. So I don't know statistically how well that works. And then there's the information ratio, which is also really easy. That's just their alpha divided by their tracking error. Traditionally, we said you want managers with an information ratio above 1. Contra Fund does that. Unfortunately, information ratios have 0 predictability. So just because a manager has had an alpha, information ratio in the past, that's really good, doesn't mean they're going to continue beating the market. That's kind of like a T statistic. What we're asking there is, yeah, they beat the market by 2.79%, but they have this tracking error. Is that outperformance due to luck or skill? If the tracking error is really high, there's a good chance it's just pure luck. You just happen to stop at a month where they had a big outperformance. The next month they may be under. If the information ratio is high, it's saying it's more likely that it's skill than luck. And that may be true historically, but it still doesn't mean 0 predictability going forward. Batting average is the only thing we could find. We had a guy in a real estate company, and he wanted to come work in my department just part-time for free. And I said, for free, yeah, we'll do that. And had a strong statistics background. We said, just go through every statistic there is on managers and figure out which of them have any statistical significance. And this is the only one he found, batting average. You know what batting average is in baseball? What would 0.757 be in baseball? That's a pretty good batting average, isn't it? So what does this mean? All they do is they take all those months and they ask what percentage of the months did you beat the S&P 500? Really simple. So 57% of the time they beat the S&P, 43% of the time below. And that was the only one. And it's R squared is only 0.52. So it only gives you a slight advantage. It's not like it's 90%. It's 0.52. But it does give you some predictability. One ratio I really, really love is the upside downside capture. The upside capture says when the market's up, what percentage of the market return do they get? When the market's down, what percentage do they get? So you can see for this fund, when the market's up, they essentially match the market. So in up markets, they essentially get the market. Where they get their value is when the market's down, they have less of a loss. They only get 80%. So they do a better job of protecting you on the downside, and in the upside, they just match. And then the beta is 0.88. So if you take my risk management class, we do this in one of our papers. It's a good analysis to have. I like to build it from scratch in Excel. And then if you interview for a wealth management firm, they're going to have FactSet or Lipper that does all this for you. I think you have an advantage if you've done it yourself by hand, to know exactly what Lipper and FactSet is giving you so that you can understand the numbers a lot better. There are other statistics, but these are the main ones. Alpha, tracking error, information ratio, batting average, upside downside capture. Those are the key. Now, what's missing here, y'all heard of Sharpe ratios and some of those other ratios. Sharpe ratios I've only seen with hedge funds. I've not seen mutual funds show Sharpe ratios. It's pretty unusual. Jensen Alpha, I've never seen that one with anybody. I'm sure someone uses the trainer. I've never seen that one. So I don't really cover those in my classes because they're just not that well used. In my risk management class, I ask students to calculate it just for fun. But you don't see the Sharpe here. You see a lot of Sharpe, but I'm not even sure people showing Sharpe even agree with it. So that's what you're up with. Passive, just give me a high R squared and low fee. With active, you got to do all of that number. All of those alphas, tracking error, information ratio, you got to do all of that. And then you got to decide, is that actually telling you something going forward? And you still have to watch fees. And then if you're buying the process, but the person who ran that fund just retired, then you got to ask, what do we do next? I had one fund, Mark was working for me, which is kind of funny because he was like twice as smart as I am. But anyway, he was working on the gold fund. And that gold fund, it was like the #1 mutual fund in the United States for 10 years. It was just amazing. He had not the #1 gold fund. He was the #1 mutual fund. So, you know, this guy, if he gets sick, we're going to be in a lot of trouble. So he's getting close to retirement. Fortunately, he had like 7 daughters, so he wasn't going to retire early. So he had a lot of kids, got to put through college, but he's getting to retirement. I picked his replacement 2 years before his retirement. So his replacement and him could sit and work together for 2 years because I knew once he retired, it was going to be like, okay, where's this fund going now? So when you change managers, that's a big deal. That fund was run by one person and it had a great history. So obviously when he retires, people are going to be like, what happens next? So you see how much more work active is. So if you're not sure, what should you do? Your uncle at Thanksgiving, what are you going to tell him? Just go to Vanguard, be passive. Why go through? You want to spend 80 hours when your chances of winning are less than 10%? Are you going to spend 10 minutes and you're probably going to win? Yeah, passive is a strong argument. Who else says that? Jack Bogle, Warren Buffett, Charles Ellis, all the big wigs in finance say, hey, most people should just go passive. It's the easiest thing to do. And that brings up this efficient market hypothesis. So pharma, I've heard of the French pharma, kind of small cap, large cap. So pharma, he wanted to study and see how efficient markets were. He did 3 tests. The weak form tests, he was testing technical analysis. So today, the Investment Society, we have a class at 5 o'clock doing technical analysis. If you want to learn that, you can go up and listen to Jacob's class. So he asked the question, can you beat the market using technical analysis? Technical analysis just looks at historical prices and volumes and tries to see if that's going to predict into the future. His answer was, it doesn't work. Now, how do you test that? It's a hard thing to test, but one of his tests that I thought was pretty kind of convicting was most people do technical analysis. They're looking at charts, and based on the chart, they're making projections. And so what he did is he created some real charts and he created some fake charts, just random. And he gave those to the technical analysts and they couldn't tell the difference. That's kind of convicting, isn't it? If the computer is doing something randomly. But can you make an argument for technical analysis? You certainly can. If you want to make that argument, Dr. Lowe, if I can find him, Andrew Lowe from MIT, there he is right there. He has a book right here. He doesn't show you how to do technical analysis. What he does is he sets up the argument for technical analysis. He goes back 3,000 years, looks at technical analysis, and he's an MIT professor, and his conclusion is there's something there. So he disagrees with Fama. He thinks technical analysis can work. He doesn't say you're going to be successful at it or I am, but he says it is possible that there are people that are beating the market doing technical analysis. It's a good book. Dr. Lowe is a very, very well-known and respected part of the investment community. Another thing you could look for, if I can spell her name, I probably won't be able to find it. Heck. Oh. See if it comes up. I just know how to spell Dalquist. There's probably another letter in there somewhere. But anyway, a former professor at UTSA, Dalquist, she has a book on technical analysis. It's about that thick. It's a really good book. If you can get through, I only got through the first few chapters. Those are really good. After that, it gets tedious because she goes through every technical there is. She says, here it is. This is how it's worked. Unfortunately, it had stopped working 3 years ago. Here it is. Here it's worked. Hasn't worked in 10 years. That's chapter after chapter. And I'm like, you get excited. Wow, it works really well. And then you go, well, it doesn't work anymore. And you're like, okay, next chapter. And it's that thick. So it's not great. The other thing you can do is go on the Bloomberg machine and just type TECH, and Bloomberg will bring up all of those technical analyses that exist and give you a description. You can plug in your company and look at their numbers. There are several of them out there. Obviously, there's a lot of web pages that do that. Let me try it one more time. I'm just convinced I can find it. And there's one right there, but it's not hers. but yeah, I can't find it. Obama says no. Andrew Lowe says yes. Those two could arm wrestle and be a tie. They're both extremely highly respected in finance. I've never met Obama. I've met Dr. Lowe a few times. He has a hedge fund, and we actually hired his hedge fund. And my staff accused me of hiring his hedge fund so I could talk to Dr. Lowe. It's like, are you kidding me? Of course, that's why we hired. So it's like, yeah, you're right. But it was a good hedge fund. So he's not only a professor, he actually runs real life money. So he has some credibility out there. The second one's semi-strong. So if you use public information, that includes technical analysis, it also includes financial statements, anything else, can you beat the market? His answer there was no. He says markets are so efficient at responding to new information, you can't consistently beat the market if you have new data. And how fast do you get the data versus anybody else? You know, that's kind of the question. I remember a few weeks into my job as security analyst, I didn't really know what I was doing, and there's no training. You just figure it out on your own. So it's like, you know, I'm sitting there sometimes just pretending like I'm doing something because everybody else is still there. Like, why aren't you going home? So I finally asked somebody, you know, 6 o'clock, and I'm usually the last one out of here. You all are here. And he's like, you did it. It's IBM's reporting. And IBM used to be an important company. So when IBM reported, it was extremely important. I said, oh, today's IBM's reporting. So I knew the second they reported because the whole place went wild. Everybody's running back to their computers, updating their numbers. You know, everybody's responding. They're staying late just to get that first number a second before anybody else. So that's the public information. That's what fundamental analysis is versus technical analysis. You're using all that information. You're trying to figure out what a company is worth. And then there's the strong form. It says, what if you use all information, including insider information? Could you beat markets? And that, he says, that's kind of hard to test. Because, first of all, it's illegal. And second of all, people that are doing it are not going to tell you about it, even if it wasn't illegal. So he can't really test that. He tried to look at things like, what do insiders do? So a CFO obviously has inside information. They also have stock in the company. So you can look at if a CFO made an unusual trade on the stock, especially if it created a tax gain, there's probably something going on with that trade that they're using inside information. But it's really tough to be able to test that. You would assume that would give you inside information. Now, there's been a big debate about Congress using inside information. Have y'all heard that debate? Congress has some committee meeting and some economist from the Fed talks, and now they know something that hasn't been reported, and they go trade on that. It was legal. Supposedly they made it illegal, but that doesn't sound like they changed it that much. That seems pretty unfair, doesn't it? If someone knows they're about to change the law, it hasn't been made public, it's going to really hurt this company, and they can go out and trade on that. That seems pretty illegal. The studies done have found that even with that inside information, our Congress members are horrible stock investors, so it's not helping them much, but still, that's there. So it is illegal to trade non-public information. So if you're on the plane and you're sitting next to the CFO of Valero, and you hear this conversation, and they say, wow, when this gets out tomorrow, boy, the stock's really going to move. We're going to report it at noon tomorrow. And that, boy, that's going to be really horrible news. Can you go home and tomorrow short Valero stock?
Yeah.
You can. What's going to happen to you? You're going to go to jail. Now, how are they going to find you? It's like, wow, Bob just traded 1 million shares of Valero. He's never done that before. Oh, look, he was sitting next to the CFO on a plane trip. So they'll find you out.
So like, be like actually like sort of like if you're just sitting on the seat next to them and sort of over here, it doesn't really count.
Yeah, it does. If you're a trader, you have inside information, you immediately go back to your office and call your lawyer.
Oh, if you're a trader, okay.
Yeah, well, I think it's anybody, but yeah, if you hear inside information, you don't go and call your broker, you go and call your lawyer. And your lawyer is going to call the CFO of Valero and say, what? You need to release this now. Don't wait till tomorrow because it's been overheard. So no, they'll find you out. I mean, Martha Stewart was an investor, right? She's not a CFA. And what did she go to jail for? Well, probably for lying, but when she was on trial for insider information, even though she's not a CFA trader.
I know it's like you're a restaurant and like you're like a table, like the executive for a company, and you're on a like a table, you're not directly with liable if you trade off that information?
I think you can, but you can see, I mean, show me the law. If you know it's not public information and you trade on it, the SEC says, no, that's unfair. You can't do that. So show me the law though, and maybe it's changed. Now, one thing, it kind of depends on, there's an important word in there is material. I didn't put it in there. It has to be material non-public information. So if it's immaterial non-public information, you can trade on that. What if you got a million pieces of non-public information and every single piece was immaterial, but combined it was with material? Then you can trade. But then you're going to go to court and they're going to go through each one, because any one of those is material, then you're going to jail. But if they're all immaterial, who decides if it's material or not? You decide that? No, the judge and jury decide that. So you're going to call your lawyer and say, I got this information. It's not known to the public. I don't want to trade on this. You know, it's not trade. So it's pretty dangerous stuff. You can, and the SEC will find you out. Because what's the SEC going to do? A stock just moved 10%. They're going to look at who was trading that stock the day or two before that and try to figure out why, especially if you did an unusual trade. You never traded more than 10 shares and suddenly you're doing 1 million shares. They're going to say, okay, what's the connection? They say, I don't see a connection. Oh, wait, his nephew was on a plane next to the CFO. So, you know, they'll find you out. So don't do it. All right. What about passive investing and what it does to our economy? Don't we want active managers, active investors, so that bad firms go out of business and good firms stay in business, and passive investing messes it up? So there is some argument with that. That's called an allocative efficiency, that we want the stock market to decide on winners and losers based on really good criteria. There is some of that. Passive is not such a large percentage that we're quite to that stage, but there is some thought that could be true. I can't remember the percentage that's passive versus active. I've seen it in the 30s before, so passive is certainly growing. Some firms, BlackRock is an interesting one. So when I was managing funds, the problem with institutional investors, they are active, but they don't try to fix companies. So if Fidelity's got 1 million shares of a company and they don't like it anymore, they don't vote the management out and fix it. They just sell the shares and go buy somebody else. They're not even trying to fix it anyway. But one thing, as a portfolio manager, you have to vote shares. The problem is if you have 500,000 companies that you're following, that's a lot of work. So we didn't actually vote our shares. We outsourced that to another firm, and they knew certain times to bring it to us that we vote certain ones. I would get phone calls. Someone's telling me vote no on this, vote yes on this. So most institutional investors don't have time for that. It's like, we don't like management, sell the stock, you're done with it. So they're not trying all that hard. There are some. What's the firm that's gotten kind of famous for being pretty advocacy based? BlackRock. I've heard of BlackRock. They're hated by the left by not doing more. They're hated by the right by doing too much. And he's trying to find the middle, and the middle is what? They hate, both sides hate him even more. Pretty tough. He's doing things that some people don't like because it has nothing to do with investing and making money. It has to do with the environment or whatever. So these are hot issues. So what is the social purpose of investing? There certainly are investors out there that are saying, hey, don't buy Exxon because they pollute the environment, or don't buy this group because they make guns or whatever. So it's kind of tough to do. I had one fund that was a kid fund, and so we had restrictions. I'm reading through the instructions. I'm like, okay, I can't buy firms that produce alcohol or sell alcohol. And I go, okay, well, Kroger sells alcohol. So, oh, that's a grocery store. That's okay. So I'm like, all right, cigarettes. I can't do cigarettes. Well, Kroger sells cigarettes. Oh, that's okay. It's like, well, I don't know what the rules are here. And then what about if they produce firearms? And they're like, this is USAA. These are ex-military. Yeah, firearms are fine. So who knows? And the rules, we almost didn't know when we're breaking the rules because it was just so wishy-washy. So it's tough. And there are firms out there that are ESG firms. And it is tough to say which firm. Brandon could probably do a lecture on this, right? right? It's pretty tough. What firms are doing well in ESG, what aren't? You have these scores, but they can be somewhat manipulated by management. It's tough. These ESG funds are really trying to define exactly who they are, how they depict companies, and it's not easy to do, but they're actually trying to influence the economy by advocacy outside of even just as investors. Warren Buffett says investing is like batting where they don't call any strikes. That'd be pretty fun to watch Major League Baseball where they never call strikes. Long games. You just wear the pitcher out. I agree with that. You don't have to trade. You can sit there and wait for a fat pitch. The problem is in finance, we're paid for swinging. When you're paid for swinging, guess what you're going to do? You're going to swing. So unfortunately, we're incentivized to make bad decisions. So you can't be that patient. Warren Buffett can be patient, but it's his money. So, he can sit around and wait and not just sit in cash if he wants to. So you got to decide what kind of investor are you going to be, passive or active. I don't think there's any shame to a finance major being a passive investor on a large part of their portfolio. I think it's, you have a limit in time, how much analysis you can do. Once you become active, your time commitment goes up tremendously because it's just a lot of work. All right, questions on EMH? And do you highly recommend Dr. Lowe? His MIT corporate finance class is out there for free. You can go watch it. You'll be amazed. It's a graduate level course. But those of you who took my 3013 class, it's no more advanced than that. You'd be able to understand everything in it. It's just really not that advanced of a class. He's a really good professor, really nice guy. You watch that class and say, well, this seems kind of basic. I'll share you Dr. Lowe. He can go very deep into complexity. I thought it was hilarious. He testified to Congress, and I was listening to his testimony. It's like there's not a single person in that room that has a clue what he's saying. It's so technical. He can go off that deep end, and he can talk to normal people as well. He's just very efficient at being able to explain things. All right. So what else can you do? I don't want to spend too much time on this. You can short securities. A shorting security, you sell a security that you think is going to go down, but you don't own the security. So essentially what your broker is going to do is borrow somebody else's securities and loan them to you. You got to put a deposit down and then you short them. If the stock goes down, you buy it back at a lower price, give the stock back to the person you borrowed it from. If the person you borrowed it from wants to sell it, you got to give it back to them and your broker has to go out and find somebody else's. But this is a very efficient process. Obviously, computers do most of that. You got to be real careful when you short a security. If you buy a security, the most you can lose is 100%. If you sell the security, there's no limit to your loss. You sell it for $100 and it goes up to $500, you just lost $400. So there's no limit. I remember whiteboarding at USAA, they had the portfolio managers, we sit with the phone reps. And once they actually had my phone on and not the other person's, like, get me out of here. I'm not going to talk to any customer. But one lady, she goes, yeah, ma'am, I just want to let you know you had this stock shorted. And she was like, oh yeah, I forgot about that. I just had a heart attack. You have a shorted stock and you forgot that you shorted the stock. I almost got on the phone then. Are you crazy? So how can you short a stock and not know you did it? So you borrow from somebody else, you pay a fee. And the fee is essentially they're going to pay you interest on what you put there. What they're going to pay you on interest is not all that great. So, but you'll get your money back plus interest. This is the securities lending industry. So this industry is quite massive. So USAA, we would lend out our securities on purpose. So the way it works is kind of crazy. So let's say someone wants 100 shares of our stock. So we loan that out 100 shares. They give us cash. We're going to pay them, say, 2%, but we're going to take their cash and invest it at 3%. We make that spread, and that's what securities lending does. Obviously, the risk there is I take their cash and invest it to make 3%, and what I invest in goes bankrupt. Then I got a problem. Because instead of making 3%, I'll make negative, whatever. There's been very few losses on securities lending, but in 2008, when you have Lehman and those type of firms going under, you can get losses in that business. But yeah, securities lending is a big thing going on. In 2008, when people were shorting stocks, we were getting phone calls telling us to stop shorting stocks because they felt like the people that were shorting were pushing the prices down. And our answer was, we're not going to do that because we're making too much money on securities lending. That's helping our customers. If we stop, it's not going to stop anything. Everybody else is going to keep doing it. We're going to keep doing it. Okay.
Yeah, so in 1981, a man named Barry Switzer was sued by the SEC because he overheard information, insider information in public place. And the SEC, the case was dismissed against him. He had no duty if he wasn't in he had no duty to keep information.
Yeah, I challenge. I'll look that up. The reason I say I'm confident about it is because that's what the CFA teaches. Now, maybe your argument is only applies to CFA, but then why did Martha Stewart go to jail? I mean, she went to jail for something else, but she was in court. So look up Martha Stewart and just see. All right. That's shorting securities. I'm not going to go through the numbers. You can kind of guess that. Buying on margin, you essentially borrow money to buy stocks. Your broker will set that up for you. You're just leveraging up your return. If you're right, you'll make a lot of money. If you're wrong, you'll lose a lot of money. So it's just typical leverage. You can read through that. The numbers are pretty straightforward. All right. What time is it? 3:12, right? Hope that is that clock right? 3:12. Does that sound right? All right. Expenses with investing, very important concept because, as Jack Bogle said, you know, if you're spending a lot of money that you don't need to, you're just killing your returns. So it kind of depends if you're doing it yourself or you're hiring a manager. So if you're doing it yourself, you have a brokerage account. Supposedly there's commissions, but commissions are essentially zero now. You might get a few pennies commissions if you do option trades, but essentially you're trading for free now. In the 70s, commissions were like 40, 50 bucks. So they've gone from 50 bucks to zero. And I'm not adjusting for inflation. So essentially the market, the brokerage world, how do they make money? It's hard to say. I was noticing the Schwab stock dropped dramatically here recently. It's tough. You notice that all the brokerages are being consolidating in order to get more economies of scale. Huh? Yeah, that's the Robin Hood story. So that means they're making money by essentially front running your trades. All right, so commissions are essentially zero. Large investors are going to do better there, but even today, that's not as big of an issue. Where small investors get killed is on the bid-ask spread. So the bid-ask, we're going to look at. Let's look at, well, I said Copart. So let's do Copart, interesting company. So the bid and the ask, 1 penny difference. So if you're buying, you're going to pay 44.01. If you're selling, you'll get 44. Pretty narrow. I like to look at bid ask just to get some sense of there's something strange going on in the market because it shouldn't be wide. It shouldn't be expensive. 1 penny is kind of expensive though, right? If you're doing 1,000 shares, that's costing you some money. So it's starting to add up. So you do want to watch that. And you'll generally, you may not notice it, but if you bought and sold the same day, it would become pretty obvious because you've essentially just thrown away that bid ask if you do it in the same day. For big investors, most of the trades I did were somewhat in between bid and ask. So we got pretty good execution. So big investors get a little bit better than that, but so it's a little bit of a different disadvantage for small investors. Where big investors get killed is on market impact costs. So market impact is you're a large investor, you want to sell 1 million shares. The stock is trading for 100 bucks. As soon as your order for 1 million shares is heard, the stock price falls because you got to get rid of all of that. So you don't get 100 bucks, you might get 99 because you got to get 1 million shares out there. So your trade causes the market to fall before you get the trade done. If you're a small investor, it's probably not an issue. My trade today, what did I do? 100 shares. Do you think that impacted the price of the ETF? Oh, wow, Professor Sweet's buying. We probably should short it now because he's buying it. Probably not. No impact. Have I ever done a trade? I don't know. There was one ETF I bought. I did $1 billion in one trade. Did that move the market? I don't know. I just needed to park cash, and so we just did $1 billion. It was pretty funny because the next day there was an article about how popular that ETF had become. I thought that was just one trade yesterday. But it's possible. It depends. That particular trade had a lot of liquidity, so it wasn't that big of a deal. But it's possible if you're doing millions of shares, yeah, you can move the stock. There's actually one portfolio manager we talked to, and their entire, remember, philosophy process, their entire process was figure out in advance what Fidelity is going to do and front run them. If they're going to sell something, we're going to short it now. If they're going to buy something, we're going to buy it now. That was their entire process. Now, they didn't know what trades Fidelity was going to do, but they look back historically what they did, and they try to guess the next trades. And that was their entire firm. That's the power of market impact cost. Your trading volume is critical. So you can look at the trading volume of a stock and try to see, if it trades 1 million shares a day, and you're going to do 3 million shares, you're probably going to move that price. So it's how much volume you're doing versus the market. You can use a transition manager to try to get best execution. I've used transition managers. I don't believe them. They seem a little fishy to me, but they do the transition and they tell you, hey, we saved you all this money, but they don't really know that. So if I've got a portfolio, say it's a $500 million portfolio, I'm moving it from manager A to manager B. I don't want to sell $500 million and hand that cash to manager B. First of all, I'm going to have market impact costs. Secondly, I'm going to be sitting in cash for a while. My investors aren't going to like that. So how do I get it from A to B? That's when you hire a transition manager. And the first thing they're going to do is get a list of the stocks A has and the list of stocks B has, and they're going to match those up. So there's no reason to sell 1 million shares of Apple and then buy 1 million shares of Apple. So you just transfer those over. So that's the first thing you do. After that, you're going to try to figure out how do they get this out to the market in the most efficient way possible. And on smaller companies, it can take them 2 or 3 days. And then they come back and say, we saved you all this money, but you don't really know that. You don't know what you would have gotten if you traded some other way. They're guessing statistically what they saved you. And it's just, to me, it's unbelievable. But we use transition managers more out of just fiduciary. You want to do it the best you can, and hopefully they know what they're doing and they're going to do a good job. Another thing that can really help is I always like doing transition management with the big index firms, because what they would do with them is they trade millions of shares every day already. They already have market impact. So what you can do with them is say, hey, I need to sell 2 million. You're buying 2 million. Why don't we just agree that we swap 2 million shares, and whatever closing price is, that's what we both get. That way we don't have any market impact. No one even knows. We just swap shares. So that's an effective approach as well. But ultimately, you're going to have to hit the market, and these transition managers should help you do that. They're trying to get you best execution. The less liquid stocks, the small stocks, that's when it's the most critical that you do it without that impact. So for a small investor, you're worried about the bid ask. For a large investor, the market impact is huge, a big part of their business. In fact, there's some small companies that actually close their fund, so they won't get so big, so they won't have market impact. Small companies can be really, really massively impacted by trades. So if you're doing security selection, those are the fees. If you're hiring a manager, we've already seen those portfolio management fees. The SEC has gotten really specific about what you have to report now, firms. So you get a lot of information. You can just compare firm to firm. We talked about the front end and exit loads. You don't ever want to pay those. There's no evidence that paying more gives you better performance. In fact, firms tend to charge more because their recent history has been really strong and they're trying to capitalize on that, but that doesn't predict the future. So there's a good chance you're paying for nothing. So you can save all that with passive investing. Would you ever buy a mutual fund without looking at the fees? No, you shouldn't. You should always look at the fees. Make sure you're getting that. I was a little bit of a pain to my poor boss at USA, but if we had a bad mutual fund, I wanted to shut it down. I thought it was horrible. And he was like, well, they want that fund. So yeah, it's a horrible fund, but they want it. But we had one that was it was like a top 100 tech stocks, and it charged 60 basis points. And someone created an ETF, which was the exact same fund but charged 20. And so I tracked the performance over time, and guess what? Ours was 40 basis points behind theirs. And I told my boss, we should just send a letter to all of our investors and tell them, why don't you get out of this fund, buy this other one, you'll be 0.4 higher, and even talk to the tax department and see if we could do it in some way so that they don't incur tax. And my boss was like, no, they want that fund. And they had to get a brokerage account to do it and all that. It's like, yeah, but can't we at least send them the letter? But he didn't want to. I just believe, you don't rip off your customers. If you know you are, at least tell them about it and let them get out of it. But he was like, no, they decided to do that. So anyway, so yeah, fees are important. In that case, it was pretty obvious. Why pay 60 when you get the exact same thing for 20? It's just, there's no debate. All right, questions on any of that? Any of y'all short stocks in here? Have y'all done that? The only sorting I do is pair trades. I do like pair trades. So a pair trade is, we did this a little bit in Investment Society. You have two companies that normally move together, like we did CVS and Walgreens, normally move together and then they separate. So you buy the one that went down, you sell the one that went up, thinking they're going to come back together. I like that because then I don't, if they both crash 40%, I'm okay because I got one that's short and one that's long. So I like paired trades. I don't like shorting stocks just completely unhedged. So if I short a stock, I'll buy a call option out of the money. So that if I short it $100, my call option might strike at 140. The worst I can do is lose $40. So I'll do that. I don't like unlimited loss, but I'm 60 years old. You're 20. If you go bankrupt at 23, big deal. Okay, I lost $1,000. So okay, start all over again. But at my age, I can't afford to risk my entire net worth. All right. So now we're going to get into returns and do some math on this next exam, so you can see some group team questions coming up here pretty quick. So how do you calculate return? How do you calculate risk? So what we do to capture returns, we usually do monthly data. You don't have to be monthly, it can be daily. And then we're going to link those monthly returns and look at some statistics. I just showed you that for contra fund. We got monthly returns, and that let us get alpha, tracking error, information ratio, batting average. So we need what we call the holding period return. That's that monthly return. We need that monthly return, and then we need the next one, and next one, and next one. One monthly return doesn't help you much, but once you get 50 or 100 of them, now you can start doing some statistic. So how do you calculate that holding period return? We're going to use a very simple approach. The CFA, if you take the exam, they require modified DEETs. I'll show you modified DEETs, and we'll talk about the difference in the two of them. But the simple approach is you take the ending market value minus beginning market value plus income divided by the beginning market value. So ending market value on a stock is whatever it closed at today. Beginning market value is not what it opened on today, but what it closed at yesterday. Okay, not the open, but yesterday's close. Accrued income, we'll talk about that. That's going to be for stocks. It's going to be dividends, but the X dividends, the key date. On the exam, I give you X date, the declaration date, and paid date. You ignore all of them except for X date. That's the only one you care about is X date. For bonds, you probably had this in your accounting class, the interest method for bonds. Have y'all seen that? So you accrue the interest on a bond. So bonds pay every 6 months. So if you're 4 months in, you don't necessarily just take 4/6, but you have to actually use the accrued interest method. We're not going to do that anymore, so don't worry about that. I'm assuming you did that in your accounting class. You got that. So here, all we're going to deal with is stocks. So our accrued income is really simple. It's any dividend they pay in a month. In the month, it goes X. All right. All right. So what's the difference between our little formula and modified DEETs? And this is it. Our formula ignores purchases and sales. It assumes we had no transactions. What modified DEETs does is it adjusts for those purchases and sales so that they don't impact the return. So essentially you want to take those purchases and sales out. So that's what modified deeds is trying to do. It's a little bit trickier formula. And you can look up modified deeds. Wikipedia has a good site on it. So there's their formula. And this weighted here, what they're doing is they're saying, okay, so we've got some cash flows. When in the month did the cash flow happen? It happened on the 5th day of the month, and you have to take 5/30ths adjustment. If it happens on the 25th, you do 25/30ths. So that's what that weight is. So they're essentially what they're doing. They're not putting the cash in. What they're doing is trying to take it out. So they're trying to take the impact of that purchase or sell out. So there's modified deeds. We use this investment society to do the return for our portfolio, which is really irritating because it means I've got to put the exact date of every single trade, of every dividend payment, every cash flow. I have to put the date, and then I have to have how many days in a month are they, and then I got to make that adjustment. So it's a much more cumbersome, but this is not on the exam, so you don't have to worry about that one. You're going to use a simpler approach. All right, so next class, what we're going to do is we're going to calculate modified deeds for several companies, give you some practice, and then I'll show you how it is on the exam. It's generally an exam question, 80% of class gets without any trouble, so hopefully we can get that to 100%. So, all right, let's stop there. Hopefully I'll see some of y'all over at USAA, or most of y'all, hopefully.